Imagine this. You deposit $1,000 into your bank account today. Tomorrow, that same bank lends out $900 of your money to someone else, and somehow, both you and that borrower still have full access to those funds. How is that even possible? Banks aren't just holding your money, they're creating it out of thin air. Stick around, because by the end of this video, you'll see the hidden engine powering our entire economy. Today, we're diving deep into fractional reserve banking, the system that lets banks multiply money like a magician pulling rabbits out of a hat. This isn't some abstract theory. It's the foundation of how your savings, loans, and even inflation work. Understanding it could change how you save, borrow, and invest. If you enjoy videos that break down money and business in a simple, honest way, make sure to like this video, subscribe to the channel, and share it with someone who should see this. Let's set the stage. Picture the early days of banking in America, back in the 1600s and 1700s. Gold and silver were king. People stored their precious metals in vaults for safekeeping. Banks issued receipts, like IOUs, promising to return the gold on demand. But here's where it gets interesting. Those receipts started trading like cash. Goldsmiths realized not everyone showed up at once for their gold, so they began lending out portions of the deposits they held, charging interest on the loans. As long as only a fraction of depositors withdrew at once, it worked fine. This was the birth of fractional reserve banking, keeping only a fraction of deposits in reserve, lending out the rest. Fast forward to today, in the US, the Federal Reserve sets the rules. Until 2020, banks had to hold about 10% of certain deposits as reserves, actual cash in the vault or at the Fed. That meant for every $100 deposited, they could lend out $90. But even after the reserve requirement dropped to zero during the pandemic, the system lives on through regulations, capital requirements, and plain old habit. Banks still operate on this multiplier magic. Now, let's break down how it really works, step by step. Say you deposit $1,000 in Bank A. They keep $100 in reserve, maybe $50 in cash, $50 at the Fed, and lend $900 to Bob, who wants to buy a car. Bob writes a check for $900 to Car Dealer Inc., who deposits it in Bank B. Bank B keeps 10%, $90 in reserve, and lends out $810 to Sally for a home down payment. Sally spends it, and it lands in Bank C, which lends out $729. This chain reaction keeps going, creating new deposits out of the original $1,000. Do the math. That initial deposit multiplies through the system. In theory, with a 10% reserve, your $1,000 could spark up to $10,000 in total deposits across the banking system. Banks create money not by printing it, but by extending credit. New digital dollars appear as loans hit accounts. It's like a money tree, branching out endlessly. Who wins big? Banks, for starters. They pay you maybe 0.5% interest on your savings, then charge Bob 5% on his loan. That spread is pure profit. In 2023, U.S. banks pulled in over $300 billion in net interest income alone. Big players like JP Chase made $49 billion in profit that year, much of it from this loan machine. Central banks love it. It lets them control the money supply without cranking out physical bills. Governments benefit, funding deficits through easy credit. But who loses? Everyday folks like you and me. This system fuels inflation. More money chasing the same goods means prices rise. Your $1,000 deposit from 10 years ago buys less today, partly because banks multiplied it into trillions. Borrowers get trapped in debt cycles, paying interest on money that didn't exist before. And if everyone rushes to withdraw, like in a bank run, the house wobbles. Remember Silicon Valley Bank in 2023? They had loaned out deposits chasing yields, and when depositors panicked, it collapsed overnight. Let me know what you think about this in the comments. Most people miss this part. To make it real, let's look at numbers from the Fed. The U.S. money supply, M2, sits around $21 trillion today. Most of that's not Federal Reserve notes, it's bank-created deposits from loans. Take mortgages. In 2024, outstanding home loans total $12.5 trillion. Banks didn't have $12.5 trillion in vaults. They created it by approving your neighbor's loan with your deposits as the seed. Psychology plays in too. Banks incentivize borrowing because that's their business model. Loans are assets, liabilities are deposits. Regulators nudge it along, assuming the herd won't stampede. But history shows cracks. The Great Depression hit when runs drained reserves dry. Post-2008 reforms added stress tests, but the core game remains. Here's the big reveal, the dark truth they gloss over in econ textbooks. Fractional reserve banking isn't safe storage with lending, it's legalized counterfeiting. Banks promise 100% redeemability on demand deposits, your checking account money, while lending out nearly all of it. It's inherently unstable, a pyramid built on confidence. If depositors lose faith, poofs, liquidity crisis. The Fed steps in as lender of last resort, printing bailouts from where? More created money. In 2020, they conjured $3 trillion in a blink to steady the ship. Who foots the bill? Inflation hits your wallet. This flips everything. That safe bank account, it's an unsecured IOU. Your money's only there if others don't claim theirs first. So what can you do? First, rethink savings. High-yield savings or CDs still play the game, but diversify into assets that hold value: gold, real estate, or stocks that beat inflation. Second, borrow smart. Use leverage like banks do, but on your terms. Low-interest mortgages for appreciating assets, not consumer debt. Third, watch the Fed. When they ease reserves or cut rates, money floods in. Time to invest aggressively. Finally, support sound money ideas. Bitcoin and crypto echo gold's fixed supply, challenging this inflate-away debt model. Demand transparency. Push for full reserve banking reforms, where deposits stay deposits, not loan fodder. It's not about ditching banks, it's about knowing the game so they don't play you. Fractional reserve banking turns simple storage into a global money multiplier, enriching banks and fueling growth, but at the cost of endless inflation and hidden risks. Next time you swipe your debit card, remember that dollar might be one of 10 born from someone's deposit. What if the whole system reset to full reserves? Would loans dry up or innovate differently? If this video helped you see money differently, like it, share it, and subscribe for more deep dives like this.